Okay, well, let's get going. Welcome, everybody. Thanks very much for coming, and we're certainly very grateful to have you. Hope everyone's having a good day. And we are here today to discuss a topic that is near and dear to our hearts at both Indinero and Lighter Capital, and that is SaaS accounting. And I can only assume if you have taken the time out of your day to join us today, that it also may be near and dear to your heart. So we're very grateful to have you. Now, today's topic, we're going to be discussing, there's the traditional view of accounting, and that is one of strict processes which have emerged over decades of slow-moving business evolution. And then now, today, we have SaaS businesses that are a relatively new business creation, only coming into prominence for the last 15 years or so. And as you all well know, with the rise in cloud computing, SaaS offerings have boomed, and there are now hundreds of thousands, if not millions, of companies offering their customers cloud-based solutions for a huge range of business challenges, all from the comfort of their web browser. Now, this is wonderful for entrepreneurs, and this is wonderful for their customers. However, with the change in the way customers use, own, and pay for the products and services that companies offer, there has been some considerable growing pains for the people who deal with the company's accounting, bookkeeping, and finances. So, today we will be discussing 6 topics that SaaS accounting experts see as critical issues for today's SaaS companies. You will hear perspectives, insights, and tips how you can present your company's financials in the best light possible when it comes time to raise your next round of investment. So a few housekeeping items. If you have questions, you should be able to enter them here in the chat panel, which you should see. So please let us know if you're not able to see that. But if you can, please, as questions come up, our intention here is to leave plenty of time for questions and answers so that you can, if you have questions specifically on a topic that isn't addressed, or if you'd like us to delve deeper into one of the topics that is addressed, please enter your chat in the bar, and we will get to that in the questions and answers session at the end. Now, quick about me. As you can see from my giant photo, I'm your giant-headed moderator, Tom Malcolm, and I serve as the head of partnerships here at Lighter Capital. I've spent the last 5 years prior to my time at Lighter Capital working in the startup ecosystems in a different number of positions where I faced many challenges that I'm sure all of you are facing today, including fundraising. Now I get to work at Lighter Capital, where I get to work for a company that helps provide funding to companies, and I work with wonderful partner organizations like Indinero, who play a critical role in getting entrepreneurs the help they need to help grow their businesses successfully. Now, but enough about me. We have 2 awesome panelists to speak to you today. Our first panelist is Carter Hawk from Indinero, and I must say that's a wonderful name. And for those of you unfamiliar with Indinero, they offer the only financial software built for tech entrepreneurs paired with bookkeeping and tax services to help run SaaS businesses. They combine cloud-based accounting software with a team of bookkeepers, accountants, CPAs. Indinero helps startup founders understand their financial health, review key SaaS business metrics, and avoid compliance issues. Tax experts work with accountants under one roof to prepare and file your taxes and maximize your tax savings. Carter specifically has a Bachelor of Management from the University of British Columbia, specializing in accounting. He's articled as a staff accountant at KNB Chartered Accountants and received a CPA and CA designations. At Indinero, Carter prepares and reviews monthly financial statements for SaaS clients, integrating current accounting standards into the ever-changing tech industry. He also consults with clients to analyze and interpret their financial records, enabling them to make strategic decisions for their financial records. And from Lighter Capital, we have one of our sharpest investment directors, Zach Haney. For those of you unfamiliar with Lighter Capital, we specialize in providing growth capital to SaaS and technology companies in the form of revenue-backed loans. Our model allows companies with recurring revenue to secure growth capital against future revenue streams without personal guarantee, dilution, warrants, or restrictive financial covenants. Based in Seattle, Washington, we fund companies across the United States, and to date, we have funded 160 SaaS companies. As for Zach, after spending several years in the Air Force, he received his undergraduate degree in finance from the Seattle University, and then he went to work at Wells Fargo in wealth management and later commercial banking at JP Morgan. And now Zach has been at Lighter Capital for 2 years, serving as both a credit underwriter and now also an investment director, providing him a very balanced outlook on SaaS companies. And before proceeding, I think it's worth noting that Carter's role at Indinero is that of one of a preparer of financial documents. He takes financial data and puts it together in these critical items, whereas Zach's role at Lighter Capital is of a finance professional, where he takes these documents apart. And so I think it's a great juxtaposition to have a preparer and a tearer apart of financial documents. And beyond that, actually, I think that if you look at Hawk and Haney, I think that we could be setting up a great TV drama about cops. So if this role in finance doesn't work out for them, they have a TV show waiting for them. So without further ado, let's get started. So we're going to start with Carter, who is going to be talking about major changes, major changes to revenue recognition rules. So Carter, without further ado, could you let us know what some of the insights that you see?
Definitely, yeah. Thanks, Tom. So just to provide some context on what we mean here by major changes to revenue recognition rules, FASB, which is the Financial Accounting Standards Board, recently issued a new revenue recognition standard in May of 2014 with the intent of providing a consistent revenue recognition model to increase comparability across companies in different industries. The standard's effective 2018 for public companies and 2019 for privately held companies, but early adoption is allowed, meaning that you can implement these standards immediately, which is often encouraged to do just so that when they actually do become effective, you're not scrambling to adopt your accounting policies and procedures at that time. So with that in mind, obviously revenue recognition standards for accounting are fairly detailed and lengthy. So we really only have time to cover some highlights here, but there's two kind of steps in the new revenue recognition model that specifically impact SaaS businesses. One of them is identifying performance obligations, and the other one is the last step in the process, which is actually recognizing the revenue and when and how to do that. So I'll start with identifying performance obligations. So a performance obligation is a good or service provided that is distinct, and the revenue is recognized on these separately. So there's specific criteria provided to identify performance obligations, and it's changed in the new revenue standard. The way that this relates to SaaS companies is because SaaS companies often offer various professional services along with the standard access to their service. So these professional services are things like implementation, customization, training, any value-added services like that. So if any of these professional services meet the criteria of a performance obligation, then the revenue should be separated and allocated to each of the services separately, meaning the regular service and the performance obligation for the professional service. To give you an example of this, if there's a contract, for example, for 12 months of service, but as a part of this contract, there's training provided upfront for the first month. If that training piece meets the criteria of a performance obligation, then the revenue from that contract should be separated between the 12 months of service and the training piece, and the revenue recognition should be applied separately to them, which may mean the revenue is recognized at different times as a result. The other piece in the revenue standards that I wanted to touch on was the last step, recognizing the actual revenue. So the wording in the new standards is such that entities are to recognize revenue over time rather than a specific point in time if any one of a specific list of criteria are met. And one of the criteria included is if the customer simultaneously receives benefits provided by the entity's performance as the entity performs, which will apply to most SaaS arrangements. So to give an example of that, if a company signs a contract for 12 months of service, the revenue for that should be recognized over the period of that service, regardless of when payment is actually collected. And that speaks to the matching principle, where we always want to try to match revenue with the corresponding costs. So if the costs of providing that service over a 12-month period are going to be incurred over 12 months, typically we want to record the revenue for that same period of time, just so that it gives an accurate idea of the profitability of that company, which I think ties in to what Zach is going to talk about next, which is actually how to book that deferred and AR for revenue.
Awesome. Carter, thank you very much. Zach, is there anything you'd like to add to that, or should we go?
Yeah.
Sorry.
No, I was just going to say that was a great overview, and just as a consumer, again, of financial statements, it's immensely helpful when we see companies following the points Carter just outlined. It really helps us get right to the heart of what we're looking to do when we begin underwriting.
Excellent. All right. Well, thanks very much, Carter, for that. And our second point we wanted to discuss today is Zach's topic of booking accounts receivable and deferred revenue. So please share your thoughts on this topic, Zach.
Yeah, just to start things off, again, AR is accounts receivable, which means you've entered a contract or provided a service and you've sent an invoice to a customer. This is more common within the tech and SaaS world for B2B SaaS, where you might be working with other businesses or enterprises. And then again, deferred revenue is an accounting tool that's used to recognize when you've received payment in advance of providing those services. So let's talk a little bit about this. Let's start with deferred revenue. So typically one thing that we like to see people avoid and not do, and it's a common mistake, is that they'll book they'll get a large upfront payment and they don't book it appropriately in deferred revenue if they're using accrual accounting. They will instead recognize all of the cash upfront. If you're using cash accounting, that may be an acceptable method, but in proper accrual accounting, you should really only be recognizing for an annual upfront payment on an annual contract, for instance, 1/12 of the associated revenue each month, and the rest, the other 11 months worth of revenue, should actually go into a separate deferred revenue account. So just wanted to clarify the proper accounting for that. And again, on the other side of the coin, sometimes what we see on annual contracts, where it's an annual contract but you're getting paid monthly, is companies will book the full value of that annual contract in AR, or accounts receivable, even though they haven't actually invoiced all those months yet, maybe just the first month and the first payment. And the issue that arises here is that as a lender or a capital provider, we typically dig into your accounts receivable aging report, and that tells us how long your accounts receivable has been outstanding. So if you're doing that, A, it's not proper accounting, but B, it really skews the AR aging report and makes it look like some of your existing clients aren't paying you promptly, more on set terms. So again, those 2 points I just wanted to bring up as things we see from time to time, and just to make the audience aware.
Awesome. Carter, is there anything that you would like to add to booking AR and deferred revenue?
The only thought that I have here that might be valuable is just that because the way SaaS companies often operate, sometimes it's not feasible to look at contracts or registrations on like a per account basis for the deferred revenue piece. So oftentimes what we'll do is just do it on a monthly basis with a journal entry, rather than looking at, if you have 5 contracts in a month, you can pretty easily figure out how much should be deferred and how much shouldn't on an individual basis. But oftentimes it's a very high volume transaction arrangement where you're taking in hundreds or thousands of payments each month for a low dollar value. And if that's the case, oftentimes it's a lot easier just to get reports from like a payment processor that will show what payments came in and the length of subscription or something like that, and you can book all of it as a journal entry at the end of the month rather than dealing with them individually.
Excellent. Thank you very much. We appreciate that. Okay, now we wanted to move to our next topic here to discuss today, is accounting for stock-based compensation, which I think is quite common among SaaS companies and other startups. So, Carter, can you let us know what your thoughts are into this?
Yeah, so stock-based compensation can obviously be a valuable tool to attract and retain talented employees when the company might have limited cash, and also just to incentivize employees. But there are quite a few accounting impacts that should be considered. So the 2 common forms of doing this are stock options, which is just obviously the option to purchase shares at a specified price at a future date, and then restricted stock, which is shares are actually provided to the employee, but they have to work to earn them. And this can either be a service or performance-based restriction. So a service-based restriction would be something like the stock option vests after 4 years of service with the company. Performance-based restriction would be something like the award vests if a specific sales target is achieved. So at a very high level, for accounting purposes, stock-based compensation is recorded as a compensation expense, much like salary would be on the P&L, and then it's either recorded as equity or a liability on the balance sheet. So there's kind of two key impacts on the financials to consider here, and that is it a liability or is it equity, and when does the expense get recognized on the P&L? And these matter because when someone like Zach is looking at your financial statements, it's going to impact the profitability on the P&L, and it's going to impact the financial statement ratios on the balance sheet. So the first one, whether it's liability or equity, it generally comes down to whether the payment is settled in shares or cash. So if it's settled as a cash payment when it vests, it's typically recorded as a liability, and if it's settled in shares, it's typically recorded as equity. An example of this would be just the most basic example. If a stock option is granted, the employee exercises the option, pays the strike price, receives share in the company, and therefore, because they're receiving shares, is recorded as equity. Something to note here, just the difference between the two and kind of the impact when thinking about how to structure this. Equity awards are measured at fair value at the grant date, whereas liabilities are revalued at the end of each reporting period. So if it's set up and structured in a way that it's recorded as a liability, it incurs additional kind of accounting work on an ongoing basis compared to the equity component. One other thing to note here is that even if it meets the criteria of an equity piece, if there's a feature in the agreement where the employee has the choice of settling in cash, then it's typically recorded as a liability. So the second item, which is when the expense actually gets recorded, so generally compensation expense is recorded over the period of time that the employee has to work to earn the shares, which is the difference, kind of the timing difference between the grant date and the vesting date. So as an example, if an employee is granted restricted stock of one share, which is worth $100, and that share vests after 1 year of service, the $100 is recorded as compensation expense over the 1 year of service. If the employee quits before that 1 year of service, then the expense is reversed. A different example using performance restriction rather than service restriction would be if the restricted stock is granted, but it's restricted by a sales target for that year, you would only record the expense at the time of granting if it's deemed probable that the sales target will be hit. So when the stock is granted, if it's probable, which FASB typically it's typically accepted that that's like 75 to 80% likelihood. If it's probable that that's going to be a target that's achievable, you would record the expense the same over the course of that year. If it's not at the time of grant, you wouldn't record anything until at any point during the year, if it becomes probable, it looks probable, seems probable, and it's assessed as probable as that sales target being hit, then you would record kind of a catch-up expense and then amortize the remaining amount over the rest of that year until the target is either achieved or not. So given the significant financial statement impacts that we've just discussed here, it becomes pretty obvious why it's important to recognize all options that have been issued, just to make sure that your financial statements are kept accurate and complete. And it's also obviously important to keep track of the vesting cycles for when different stock options and restricted stock are vesting for your employees. One other thing to note here is that recently there's been some new guidance released by FASB. So in 2016, March of 2016, FASB issued new guidance for stock-based compensation. It's effective 2018 for privately held companies. The key impacts of this are just that the tax impact of issuing stock-based compensation will now go all directly to the income statement, whereas previously it was deferred on the balance sheet, and it'll be included in the operating activities on the cash flow statement. The tax impact is the difference between the compensation expense that gets booked in the financial statements and the actual tax deduction that you get as a result. So that's kind of the latest in the riveting world of accounting standards.
Yeah, well, that's certainly, I'm sure to many people here, that's very, very relevant information. So thanks very much, Zach. Is there anything that you want to add to that from kind of the financial perspective, what we look at as investors?
Yeah, so typically we analyze cap tables as part of our analysis. Digging into any potential cash liabilities related to vesting shares or issuances is always, a concern for us as we're looking at other considerations paired with that, like cash runway or ongoing burn as a company is growing. We just want to be aware of any liquidity needs the company may have coming up as a result of maybe a large owner of shares in the cap table leaving and needing to be cashed out.
Cool. Excellent. Okay, well, without further preamble, we'll go to our topic number 4. Zach was going to share some of his perspective into combining subscription or licensing revenue with other streams of revenue.
And this piggybacks and kind of dovetails with Carter's earlier topic from the beginning of the presentation. And then this is more of my perspective based on what we've seen historically as we review financial statements of various companies we've worked with or look to work with over the years. A common thing that we sometimes see is that revenue is broken out on the P&L, especially if there's a smaller customer base in terms of count by customer. And what this really, the problem there is that really skews the breakout of the recurring ongoing revenue versus the one-time services revenue, especially if there's a flat subscription fee, and then sometimes billing is charged for training, as Carter alluded to, or other ongoing one-off services for specialized R&D, maybe required to optimize software, that sort of thing. When we're looking at creating or a revenue-based financing loan, within our world specifically, we're always digging into what's the real recurring revenue in the business, and being able to delineate between recurring revenue across all clients and then one-time subscription revenue or non-subscription revenue is just a very important delineation for us as we do our analysis. So I just wanted to touch on that point and kind of piggyback on Carter's earlier topic.
Awesome. And Carter, is there things that you can see from kind of the accounting perspective about this topic, about combining the various combining or delineating these revenue streams, or kind of any tips that you might suggest to people in attendance here?
Yeah, I mean, so it definitely makes sense to me that from someone like Zach's perspective, it would be much more helpful to have the revenue pieces broken out by revenue stream rather than by customer. The only thing I would add, I think, is that so for one, to circle back to what we originally talked about, if you have separate, even if it's part of the same contract, if you have separate performance obligations as part of that contract, you should be breaking those out and recognizing the revenue separately anyways. So it shouldn't be too much more administrative or accounting work to separate those as different line items on the P&L. And the other thing that I would suggest is that in doing that, it's going to make kind of supporting financial reports such as budgeting and forecasting much easier to do if it's broken out like that on the P&L, because typically the P&L is your starting point for those items. So if it's already broken out like that, you can see your MRR, which is recognized differently than your professional services. It's much easier to put together something like forecasting and budgeting documents.
Awesome. I appreciate that additional perspective. And now moving right along, so we're going to look at our topic number 5 that we're presenting today. So this is something we're describing as capitalizing the cost of acquiring new customer contracts. Carter, could you please enlighten us as to what that means?
Yeah, and this actually also ties into the new revenue standards that were released by FASB as well. They touch on this. So in general, the costs associated with acquiring new customers can be expensed as it's incurred, or it can be recorded as an asset on the balance sheet and then expensed over the period that service is provided to the customer. So currently, under current US GAAP standards, you have the option. You can either expense it as incurred, or you can capitalize it as an asset and amortize it similar to revenue. But with the new accounting standards, which become effective in 2019 for privately held companies, it actually makes it mandatory to capitalize the incremental costs of obtaining a contract if the costs are expected to be recovered. So there's a couple questions in there that are probably valuable to answer, and that is what costs should be capitalized, and it's incremental costs. So that is costs that would not have been incurred if the contract had not been obtained. The most obvious example of this is salesperson's commissions. Typically, if the contract isn't obtained and signed, the salesperson's commissions aren't an expense that gets incurred. Salesperson doesn't get paid. Costs that are incurred, whether the contract is obtained or not, are expensed still. So an example of that would be marketing expenses, for example. So those are costs that are going to be spent anyways. If the contract isn't won, those costs are still being incurred. Those get recorded as standard expenses, whereas salesperson's commissions should be capitalized as an asset and then amortized over the service period. So the second question there is when to record the actual expense once you've capitalized it as an asset. And the answer is it's over the period that the service is provided to the customer. So one thing to note here is that if the amortization period is 1 year or less, the accounting standards allow you to just expense it as incurred, continue doing that if you've been doing that. But if it's more than a year, the standards dictate that it should be capitalized. One other thing to note is that the amortization period might be longer than the initial contract length if the costs are not incurred again each time the contract is renewed. So as an example of that, if there's sales commissions on a 1-year contract, those commissions should be capitalized, and they might be amortized over more than that 1-year contract if the entity expects the contract to be renewed. So for example, if they have an average customer life cycle of 5 years, then presumably they would expect that customer to renew their contract for approximately 5 years. And so as long as after the first year the salesperson's commissions aren't getting repaid with each renewal, then the initial upfront costs paid to that salesperson for obtaining the business would be amortized over 5 years, not 1. At any point during that time, if things change, if the contract isn't renewed when it was expected to be renewed, if the contract is canceled, and you have this asset sitting on the balance sheet, then an impairment loss is recorded just to remove the asset from the balance sheet. And yeah, that's pretty much it for the new standards for capitalizing costs of acquiring new customers.
Okay. Well, Zach, if you have nothing to add to that, then we can carry on to our last topic for the day before we jump into questions and answers. And again, if you have any questions that's kind of specific to your business, I encourage you to write them in the questions chat tab, and we'll definitely get them to them shortly. But before we do that, again, the last topic here will be breaking out payroll expenses, which might be kind of connected to some of the previous topics we've had. But Zach, please let us know what you're thinking here.
Yeah, again, in our analysis, just depending on the level of granularity you use when you're preparing your books internally or using an external provider like in Dinero, it's somewhat common for us to see that all of payroll, maybe the only delineation being employees versus officers, but all of payroll being lumped into one account. When we're doing our analysis, it's very important for us to analyze fixed costs in a business versus variable. And with payroll being the largest single expense, it's important for us to understand, is our baseline amount of G&A or general and administrative type of employees that doesn't really grow with the amount of revenue necessarily in the business, whereas customer success people or sales people may need to be added as revenue grows. So again, in terms of understanding what those costs are and how they may scale with the business as revenue grows or unfortunately shrinks in some situations, it's very important for us to understand within payroll, who is in the G&A bucket, who is in the marketing and sales bucket, who is in the R&D bucket, etc., so that we can properly identify what are the fixed and variable expenses in a business as we're doing our analysis. One other consideration is that if you do use internal developers and you're paying them as payroll, sometimes depending on what they're providing, and this goes with sales people as well, what services they're providing, it may be warranted for our analysis purposes to look at this as somewhat related to cost of goods sold, especially if it's a developer doing one-off work for a services contract to help an existing client optimize the product for their other needs. So it's important for us to be able to accurately analyze what an effective gross margin in the business is, and being able to allocate costs associated with revenue is important. And again, this all just ties back into tech companies, the primary expense being its people typically, and us being able to delineate between variable costs and fixed costs within payroll.
Excellent. And Carter, is there anything that you want to add to that last topic? Just looking at kind of the payroll expense from that accounting world you come from.
Not much. No, I think those are great points. I guess the one thing to consider there is that it shouldn't add a ton of work to break out payroll more granular like that, given that if you have employees on payroll, you should already be doing payroll reconciliations, because obviously there's remittances for tax withholdings, right? So, which is an important piece. Typically you want to be on side with the IRS, so it's something you should be focusing on anyways. So to break those out into separate accounts shouldn't entail a ton of extra work.
Yes, being on site with the IRS is certainly something we encourage. And so that leads us to now the question and answer session. So we have some questions here, and for those of you, if you have anything kind of that's been stirred up through this conversation, please go ahead and enter it in the chat. You have an opportunity here to get some advice from professionals, and we will not send you a bill at the end, I assure you. So first question, we have Juliana asks, do you need to record stock compensation related to RSAs/options when there is no established par value for issued preferred stock? Carter, that might be a question for you.
Yeah, so that's more for accounting purposes. There's not much to record there, but there's often tax implications, which I don't know if I want to get into that here for two reasons. One, it would probably take about an hour, and two, I'm not a tax specialist, so this is where I would usually run to our, at Indenera, we have a team of tax specialists that I would usually run over to, and then once I deliver the question to them, run away from. So while there's little accounting implications, but there's often tax implications that would probably be worth diving into a little further. Sorry, that's not more helpful, but
that's more than fair. More than fair. And Zach, do you have anything that you've seen in your experience?
Yeah, just to point out that to get a 409A valuation, you typically need audited statements. At which point you could assign a par value to your shares. And early in the life cycle of a startup, this isn't always feasible, maybe from a cost perspective, but it's the cart before the horse. So I can see why this would be a common question.
And just one housekeeping item. There was also a question about whether these slides and this recording will be available. So we actually will be following up. So if there's kind of things you want to go back and listen to, you will have access to the recording. So that was a question here. And Carter, one quick question for you. It says, what are the FASB numbers that Carter is referring to? I think that's probably a pretty important item.
The FASB numbers for the revenue recognition, yeah.
Or maybe not.
I believe it's 706.
So I don't know if that means either the definition of FASB or if there were certain numbers that were related to that. But
yeah, so there's FASB is the Financial Accounting Standards Board, which is the board that directs accounting policy for U.S. GAAP. The new revenue recognition standards, I don't want to give you the wrong number here, so I'm going to try to use Google to my advantage, but I believe it's ASC 606. Is it 606 or 706? I think it's 606. Yeah, so that's the standards that were released in May of 2014, and then in 2016 they actually released a bunch of amendments and clarifications just because people were there was uncertainties around certain things. So there's been updates since 2014, and they're actually effective in 2019.
Cool. Wonderful. And we have a question here for Zach. It says, can you give an example of recognizing stock-based compensation that would raise a red flag for lighter capital?
So in terms of what our perspective would be, as we're digging into the financial statements, this would maybe more pertain to a co-founder leaving rather than a traditional employee. But if there's implications that there could be a cash liability associated with maybe the CTO co-founder decides to leave and go do something else, start another startup. If there's an obligation at the point of their exit to buy back those shares, and it's a company that doesn't have the cash reserves to necessarily do that, that can be a little eye-opening for us, and is a risk that we like to address as we go through our diligence.
Cool. Hopefully that addresses that issue. And another question here, if the sales commissions are also paid for renewals, then what would happen? So I don't know if that's related to cost of goods sold or payroll expenses.
Carter, maybe this is for you, related to stretching out the recognition.
Yeah, so I think the way that they actually word it in the standards is that it's something like if the commissions on renewal aren't commensurate with the initial ones, then it still applies. So for example, if you're paying like $1,000 in commission for the initial contract to get signed, and you're expecting that to last 5 years worth of business, you would still amortize that $1,000 over 5 years, even if there's like $100 or $200 commission upon renewal. Having said that, if the commission for renewal is the same as signing a new contract, that wouldn't apply. You would amortize the you'd amortize the asset, which is what you've capitalized those commission costs up front, over just the length of that initial contract, if to renew it incurs the same cost as signing a new one.
Mm-hmm. And here, a related question on this topic is, what if you're a relatively new SaaS provider, and you do not know the expected lifetime of a relationship with the customer? How do you determine how long to prorate the capitalized expenses?
Yeah, so I mean, there's always some gray area and judgment involved, right? So if that's the case, you have no track record to work with. Using the contract length is probably reasonable. Having said that, if there's reasons for you to think that the contract length isn't in line with what the life cycle of that customer, then you would just have to apply some professional judgment there. But typically, yeah, the contract length would kind of be the default, unless there's something that suggests that you can reasonably expect to maintain that customer's business for more than the length of the contract.
Thank you very much, Carter. Zach, do you have something that you want to add to that?
And this can tie into, as a SaaS entrepreneur, when you're looking at your overarching SaaS metrics. If you start having a sense of, if you're doing customer acquisition costs versus lifetime value costs, the lifetime value, you should be sort of beginning to gauge based on churn and retention how long you're typically keeping customers. You may be able to forecast based on historical retention among cohorts, kind of what the expected lifetime and renewal of a existing customer might be.
Cool. And here another question. Can you give a brief comparison between GAAP and IFRS revenue recognition, specifically for SaaS companies? And so, is that a deep dive topic? Is that something that you can briefly address, Carter, or is that?
Yeah, I mean, I can't go through all the revenue recognition standards for those, but it's a relevant question because this new proposed revenue recognition standards from FASB, it was issued jointly with IASB, which is the board that dictates IFRS. So it's a joint revenue recognition standard to kind of merge the two standards for revenue recognition purposes. So once it's implemented, which is 2018 for public companies, 2019 for privately held, the revenue recognition between US GAAP and IFRS should be nearly identical. The only reason it's not identical is just because since it was released in 2014, FASB and IASB have independently released kind of clarifications separately. So there's a few pieces that are very detailed where they're going to differ a little bit just in their guidance, but in general, the revenue recognition policies will be the same moving forward.
Cool, thank you. And here a question says, currently I'm not accounting for any payroll against the gross profit margin. We have R&D and G&A and sales head costs, only 15 people. Who should be included in a small company? So maybe that's kind of just referencing, what are the roles and who should be included where, whether it's kind of included against gross margin or kind of cost of goods sold.
Well, Carter, if you want to start off with the accounting from your side and preparing the statements, I can comment on how we look at it from an analysis perspective.
Yeah, so just to make sure I understand the question, right now they're not recording any payroll in cost of goods sold. It's all going to different operating expense accounts. Is that right?
That seems to be correct, yes.
Yeah, so that's not that uncommon. The only thing that you want to look at, and I think Zach touched on it a little bit, is that if there's any pieces of your payroll, any employees or any specific items running through payroll that are variable costs, right, that are directly tied to your revenue, those are the ones that you want to allocate into cost of goods sold. And I mean, that can be, it's not necessarily a specific employee, it can be a percentage of an employee's salary as well, right? So the most obvious one is like salesperson's commissions, because those are directly tied to revenue. It can also be things like managers' bonuses that are based on revenue targets, just anything that's directly linked. And the reason you want to do that is just because, I think Zach mentioned it earlier, just because it impacts your margins. So to keep those accurate, your profit margins, you'll have to include all variable costs in COGS rather than operating expenses.
Yeah, and just to kind of piggyback again on that, yeah, those are the types of one-time attributable operating activities that are really tied to revenue that may be moved up to cost of goods sold. when we do analysis, we want to see what are those variable costs that are that fluctuate in line with revenue generating activities for the business, and therefore would be expected to scale up or down with the revenue of the company as those services are provided to the customer. So it's just important for us to know, what's the true gross margin of a business. And to touch on the earlier point of this example, it's not uncommon for us to see nothing in cost of goods sold, or maybe just hosting fees for back-end hosting services for the software itself, if it's cloud-based, in cost of goods sold. But when we do our internal analysis, sometimes we'll try to identify those line items if we can pick them out of payroll, and then move them up to cost of goods sold to get a more accurate picture of the gross margin in a business.
Excellent. And here, I guess the last question we have so far today would be: if we don't have, if we're doing our accounting in-house, should we find an accountant that specializes in SaaS, or is this are these standards that all CPAs will know? So Carter, this might be a good opportunity to plug into Nero.
Yeah. I mean, it's obviously you have the choice of going to any CPA, and you're going to most likely be in compliance. What I would just say there, though, is that if it's an accountant that isn't well versed in kind of the way that SaaS companies work, and kind of how to apply the accounting standards to that model, you're going to probably run into some issues, both in terms of how to set up your financial accounts and your financial statements, and then also booking entries on a day-to-day basis or a week-to-week basis, because it's quite a bit different than a conventional business, right? Where you buy and sell goods or something like that, just in terms of like a retail store. There's certain things like, if you're processing thousands of transactions that are low dollar value but high volume of transactions through an online payment processor, it's tricky if you haven't done it before, if you haven't looked into it, to figure out how to actually, even if you know how the financial statements should look and how to apply the accounting standards to it, it's tricky to actually go about getting it into the financial statements, just managing that volume of transactions. So I would definitely suggest going with someone who is well-versed in both doing kind of the bookkeeping and preparing for SaaS businesses, and then also someone who's well-versed in applying current accounting standards to that business model.
Awesome. Zach, anything else?
Yeah, and again, dovetailing with everything Carter shared, we've seen a breadth of different of levels of quality in terms of the books that we receive, in terms of if it's true cash, true accrual, some hybrid, and companies that are engaged with someone that knows really how to look at SaaS books and put them together. Those statements usually enable us to move a lot quicker on our end, really help answer any questions we have, and provide a lot of clarity in our analysis. Where if you're doing it internally, or you're working with a bookkeeper or a CPA that is not as well versed in working with SaaS companies and booking things properly, it can create a lot of issues, slow down the capital raising process. The bread and butter of what a VC is going to look at, what an angel is going to look at, what we look at is really in the financial statements. And so having a clear picture and being confident that the numbers we're seeing are accurate provides definitely a big boost to our ability to really assess the company and its creditworthiness.
Wonderful. Well, thanks everybody. So this is going to kind of conclude our webinar today. You can see there's contact information. We would love to carry on a conversation. If you're interested in learning about revenue-based financing and non-dilutive capital available for SaaS companies, Lighter Capital would certainly love to have a conversation with you. You can see our contact information here. And the fine folks at Indonero would also love to be able to help prepare your business for success with accounting and bookkeeping services. So thank you all for joining us. And also coming to TNT next November will be Hawk and Haney, the TV cop friend. So thank you guys so much. We appreciate your attendance and effort and showing up today. So hope you got some value from it, and we'd love to carry the conversation on with you. So thank you all. Have a great day.